kind of investor who could actually look at this kind of funds is the person who has a time horizon for investments of 3 to 5 years.
Hello everyone and welcome to our channel, The Mutual Fund Guys, where we only talk about mutual funds. I'm Samir and on the other side is Mahesh. Mahesh and I are partners at AMS Investments. We are mutual fund distributors based out of Mumbai with an office in Dubai, and we currently manage mutual fund portfolios for about 100 plus clients. So having said that, let's dive straight into today's topic. Today, we're going to talk about hybrid funds again. In the previous video, we spoke about what exactly are hybrid funds.
Yeah.
And that was a pretty comprehensive video talking about hybrid funds in detail. But in case you missed that video, let's just quickly recap, Mahesh, what hybrid funds are for people who are tuning in right now. Hybrid funds are nothing but a hybrid of equity and debt in most cases. In some cases, there is also a mix of another asset class, which is either gold or real estate investment trust or any silver or any other commodity. But in most cases, a hybrid fund is a balance between equity and debt. These are two primary asset classes that balance funds are made of. Because it's equity and debt, there are various benefits of hybrid funds. And it makes a lot of sense for a great deal of investors to remain invested in these hybrid funds. So today's topic is going to be about which investor will appreciate a hybrid fund. And Mahesh, maybe you can start off with one of the investors or a profile of an investor that you think might fit into category of a mutual fund investor in hybrid funds.
Samir, basically, before we talk about the investor itself, I would like to point out one thing, which is that the return profile of all these hybrid funds as an asset category is typically such that it doesn't make as much money as a pure equity fund. But at the same time, it doesn't have the same volatility, which means the returns don't go up and down as much as the pure equity funds returns go up and down, right? So the hybrid funds, by their very nature, because they have both equity and debt in them, tend to mute the returns on both sides. So they will not give as much returns on the upside, nor will they fall as much on the downside. And given this return profile, we can see which are the kind of investors that it will help. The first kind of investor who could actually look at this kind of funds is the person who has a time horizon for investments of 3 to 5 years. So it's not really long term. It's not the kind of time horizon where we say I'm doing this to build my wealth and not necessarily with any particular goal or objective. But here is a investor who wants to look at investing only for 5 years. And that could be because he has a certain need of funds in 5 years' time. It could be children education typically, or it could be that in 5 years he foresees buying another house, things like that, right? So any need could exist, but where it is very clear from the investor's perspective that the funds that he's investing has a limited time horizon for that investment, right?
So just to summarize, so a hybrid fund is a great option for somebody, an investor who's looking to be invested for about 3 to 5 years. The person's time horizon is very short because he or she needs the money in the next 3 or 5 years. It's a great option for people who have a limited time to be invested in the market. They appreciate the upside that the equity markets bring to the returns, but they also want to be conservative because they need that money in 5 years. Hence, the debt components helps them out. So that's it. And the next one you think, Mahesh, would be who?
The next one could be, and this is from our experience, right? I mean, the next person who should be given hybrid funds is typically a first-time investor himself, in the sense that not somebody who is 25, but somebody who has not yet invested and is in the late 30s to early 40s, who is beginning his investing journey in the markets for the first time. And when you are investing for the first time, the volatility that markets can bring would be something that the investor might find difficult to handle. And for such an investor, a hybrid fund is a good way to ease himself into the process of investing, right? He starts investing in a hybrid fund, sees that some kind of return come in, and then starts moving into more riskier equity funds.
Those who are watching, if you're in your 30s or 40s and you have not yet invested in mutual funds or any sort of stock market related funds, you might want to use hybrid funds as an entry point to ease yourself into investing in equity and debt. It'll give you, in the past, it has given, very decent returns. And this might be a great option for those who are late in the investing journey, but could start off their journey with hybrid funds and then perhaps move into equity funds if they so desire.
Even if you look at it in this way, that there's a investor who is very clear that asset allocation is a very important part of investing, right? So it's not just about investing purely in equity, but also about asset allocation. So he realizes that having a good asset allocation helps build long-term wealth. That investor could even consider putting almost all his money in hybrid funds, right? Because automatic asset allocation happens, but at the same time, instead of allocating separately in equity and separately in debt, which is tax inefficient these days, you invest in asset allocation funds or in hybrid funds and get the benefit of efficiency in tax. And you really have the advantage of not having to pay tax even when the fund manager moves between equity and debt. Whereas if you did it yourself, every time you made some kind of asset allocation rebalancing within your portfolio, you would end up paying tax, right? So this is one of the ways that people use hybrid funds.
Yeah, I think it's a very important point, Mahesh, about hybrid funds. You could create your own hybrid fund in the sense that you could buy an equity fund, okay, and then also buy a debt fund. But as you said, if you do that, you are not using it's not a very tax efficient mechanism for you. Whereas in a hybrid fund, you can get similar allocations that you want to have in equity and debt, but get the benefit of equity taxation, which is 10% long term on your profits and 15% short term on your profits, versus debt, which is taxed at your marginal rate of return, which in many cases would be 33%. Instead of doing it on your own, having a debt allocation separately and having a equity allocation separately, use hybrid funds, because that vehicle itself provides you that tax advantage in most cases. Not in all cases, but in most cases, it provides you that tax advantage, which is very beneficial. You end up saving a lot of money over a long period of time if you remain invested.
This is really very, very important, what you're saying. This kind of tax efficiency that equity taxation gets is not possible when you do it separately. And that is one of the big advantages of a hybrid fund that we have. As of today, this advantage exists, and everybody should try and benefit from that advantage, right?
Can you give us a little bit of summary as to the returns of these funds over the last 10 years, the hybrid fund category? I know we've discussed this in a previous video, but just quickly, maybe in 1 or 2 sentences, what has the category given on average?
Incredibly, one of the things that we work on is called as the 3-year rolling return, right? In the sense that if an investor bought at any point in time and held for 3 years, what is the returns that investor would have experienced? So in any point in time and holding for 3 years. So that is called 3-year rolling returns, right? We can calculate the average of all these 3-year rolling returns. That is a better way of saying what has this category done than looking at a point-to-point return and say that this is what it was in the last 5 years or 2 years or 10 years or 1 year. So we look at 3-year rolling return because that really tells you what these funds as a category can do. So
and what the investor experiences as well.
And all the returns that I'm talking about from now on is compounded annual growth rate. That is, it is not
yearly, every year.
Yeah, it's a growth rate on an annualized basis. If you look at the hybrid aggressive, which is 70% equity, 30% debt, on an average, the 3-year rolling return is around 15.4%. Right? Wow. That is the kind of return they have given. Excellent. And the minimum return that they've given in any 3-year period is 1.5%. So it's not negative, right? If you hold for 3 years, you still got at least a positive return. And on an average, you got 15.4%.
And in the worst case scenario, you got only 1%, 1.5%.
1.5%, right? 1.5%. Because that is the more aggressive form of a hybrid fund, which is you have 70% equity and 30% debt. Then the kind of funds that we normally like to sell, normally like to advise to people or investors is that the dynamic asset allocation fund, where the fund manager can actually move between equity and debt. right? Move
as per their discretion.
As per their discretion, yes. And that on a 3-year rolling basis has given around 11.4%, 11.4% compounded returns. But the minimum is actually 3.5%. So it's much more than the aggressive category of funds, right? So you are pretty much assured that if you buy dynamic asset allocation fund and hold for 3 years, you will at least get 3.5%. I mean, this is the past, obviously, but that is what it has given in the past, right?
Yeah, and I think it's a great follow up on the other thing is, if you look at dynamic asset allocation funds, they have given minimum of 3%, 3.5%, and an average of 12% or 11.89%. 11.89% is essentially what Nifty has given in the last, Nifty index on a rolling basis has given over the last many years, right? So the dynamic asset allocation fund has actually managed to give you equity kind of returns over
almost equity kind of returns,
and with also on the downside FD kind of returns on a post-tax basis, not on a pre-tax basis. I mean, less than FD returns on a post-tax basis, but chances of you making those 3.8% returns, lowest returns, is highly unlikely for two reasons. One is that you don't invest everything in one shot. Usually investors will invest SIP through a period of time. So they will actually experience those average returns of 11 and 12%. They will not experience those small returns of 3 or 4%. Just as you said earlier, a hybrid fund is excellent starting point to experience equity kind like returns without that too much risk associated with equity funds.
In fact, any new investor that I get or we have almost always suggested these funds first, seen how they react over a period of time, and then move ahead to more riskier category, because that eases them into this whole business of investing, right? Because we also know that over a period of time, they will, as long as they hold for a long enough time, then they will experience, even in this dynamic asset or an aggressive hybrid fund, almost equal to equity returns. So it's not such a bad deal after all.
All right. So thanks for that, Mahesh. I mean, again, the purpose of this video was to highlight for who a hybrid fund might be beneficial, or for which classes of investors it might be beneficial. I hope you liked the video. If you have any comments or any questions, you can write to us at hello@amsinvestments.net. If you also looking for a free consultation of your mutual fund portfolio, or are looking to invest in mutual funds, please contact us at hello@amsinvestments.net. Both Mahesh and I would be happy to go through your portfolio and advise you accordingly. Thank you so much. Hope to see you guys soon.